Hello, everyone, and welcome to today's NOVA presentation, Secure 2.0 Roth Catch-up Best Practices, hosted by Kim Rader and Michelle Miyanaki. Before we get started, I would like to go over some housekeeping items. First, I'd like to point out the question mark icon at the top of the webinar screen. This is where you'll enter any questions you have for us throughout the presentation. Please keep in mind the Q&A portion of the session will be held at the end if we have time. If time runs out and you have questions, please email us at webinars@nova401k.com and we will make sure we answer your question. Right next to the questions, you'll see a paper icon. This is our handouts dropdown where you can find today's material in PDF form. If you are unable to view or click on the handout, go ahead and send us an email and we can provide you with that PDF. If you're here today for Never mind, I don't believe we're offering CE credits today. So if you do miss today's webinar, we will be having it on our YouTube channel, which is Nova 401k Associates, or you can visit our website at nova401k.com/webinars. Thank you for joining us. I'd like to now introduce today's presenter, East Coast Team Leader Michelle and Kim Rader, Director of DC Client Relations.
Hi everyone, thanks for joining us today. As Ava mentioned, we're here to discuss Secure 2.0 Roth catch-up, the new regulations, and suggest some administrative best practices on how to implement these new rules. Our disclaimer, this information in the presentation is general in nature and not intended to be a substitute for legal or tax advice. So you're always going to want to consult a qualified professional, such as an attorney or an accountant, if you need legal or tax advice. On our agenda today, on the next slide, Kim. On our agenda today, we're going to talk about several items, including a brief overview of what exactly Roth is. We're going to talk about catch-up contributions. We will then take a look at the new Roth catch-up regulations under Secure 2.0. We will then go into the required plan document amendment and the timeline of implementing this amendment and these new provisions. We will give you some tips on some best practices to keep your plan running smoothly. And lastly, we will cover a few frequently asked questions. So to get started, just a little history about Roth contributions. In 2001, a law called EGTRA first introduced Roth 401k into retirement plans. 2006, the Pension Protection Act made Roth a permanent provision in 401k plans. And now, fast forward to 2023, we have a new law called Secure 2.0, which I'm sure you've heard of by now. This introduced Roth catch-up for higher earners, which is what we are talking about today. So what is Roth? Roth 401k contributions in a retirement plan are similar to traditional pre-tax contributions in that they are deducted directly from the employee's paycheck and deposited into a retirement plan. However, the main difference is that Roth are deducted on an after-tax basis, meaning that they are subject to payroll taxes, whereas pre-tax traditional 401k are before taxes. Roth contributions are subject to the same limits as regular pre-tax 401k contributions. So for 2025, the 401k limit is $23,500. So between your pre-tax and Roth 401k, a participant can only do $23,500. This is before catch-up, which we'll talk about in a minute. But the limit is combined. So if you're doing 10,000 401k, you could only do 13,500 Roth. The limit is a combined limit. So why would a participant want to pay taxes now on their contributions? The main benefit of making Roth contributions is that the earnings grow tax-free and they accumulate for as long as the money stays in the plan. So you can see that this could be quite a benefit for younger employees, or not even younger employees, but employees that have several years until retirement. The earnings can grow tax-free and compound those earnings, keep growing tax-free. The main thing to remember though is that to get the benefit of the tax-free earnings, when you take the distribution has to be a qualified withdrawal, and we will go over that here on the next slide to talk about what a qualified withdrawal is to get that tax-free earnings benefit. And due to the different tax treatment of Roth versus your traditional pre-tax contributions, when this money is put into the plan, it has to go into separate accounts at the record keeper. So as a plan sponsor, plan trustee, the main thing you need to know is when you deposit it into the record keeper, you have to put it, separate it out. And then once it gets into the plan, that's up to the record keeper to keep track of that money. And then on the next slide, we will talk about, as it's flipping here, the 5-year rule to make a qualified withdrawal, which we were talking about. So the benefit, as we talked about, of the Roth is that the earnings are growing tax-free. But to take advantage of this, the withdrawal has to be qualified. So that means once the money goes in, you have to wait 5 tax years and be age 59 and a half before the earnings can be withdrawn to be tax-free. So just as an example, if you made or a participant made their first Roth contribution June of 2020, the 5-year clock starts, it always starts on January 1st of that year. So they could withdraw their earnings tax-free starting January 1st, 2025, as long as they are age 59 and a half. Next, on the next slide, we're going to talk about something called in-plan Roth conversions. This is a financial strategy with Roth that allows you to convert pre-tax funds in a retirement plan to Roth. So the reason you might want to do this is you could have existing pre-tax money that you already invested in the retirement plan, maybe prior to the plan having Roth available, or you just didn't, at the time, didn't want to deposit into the Roth, and now you want to take advantage of some of that tax-free earnings growth. If your plan allows it, you can convert your pre-tax money into Roth, and then once you do that, the money that you converted into Roth, the earnings will grow tax-free. So when you do this, you have to pay income taxes on the money that you converted. So say you have $100,000 of pre-tax money. So you have a existing in your plan account balance of $100,000 regular 401k money, and you want to convert it to Roth. You're going to do that. You'll get a 1099 for $100,000, and you'll have to pay taxes on that. So you're always going to want to get some advice from a tax advisor or your accountant to make sure that you are in a good position to do this and have the money to pay the taxes on this. Since the money is staying in the plan, you're just converting it from one source to another. There is no early withdrawal penalty on this conversion. Sometimes, typically when you take a withdrawal before the age of 59 and a half, there is a 10% penalty. But in this case, you're not necessarily taking a withdrawal, you're just converting money. So there's no penalty. As I mentioned, a plan must allow for this. It's optional. Not all plans do this. So your plan might not necessarily allow for this. But why would you want as a plan administrator, a plan trustee, why would you want to allow your plan to do this? Well, it could be convenient for yourself or for your employees. If you allow it in your plan, you don't have to open a separate Roth IRA outside of your 401k plan, so you can keep the money in the plan. So it's just a convenience, but for today, the purpose we're talking about it is these Roth in-plan conversions are going to be a primary correction method that will be used with these new Roth catch-up for higher income earners when we have to make a correction when money is deposited incorrectly as pre-tax. And we'll talk about that in a few slides from now, so we'll get into that. So remember these in-plan Roth conversions. So on the next slide, so now we learned about Roth, we're gonna talk about catch-ups. So I'm sure most of you have heard about catch-ups, but we'll just go over them briefly. So catch-ups are additional 401k amounts allowed for, they're allowed above the regular 401k limits for those individuals that are age 50 or greater. And Congress basically created these catch-ups as an opportunity to allow people closer to retirement age basically to catch up on their retirement savings and save additional money. There's three ways, basic ways catch-ups can be used. The traditional way is when an employee contributes more, and this is the most common way that catch-ups are used, that you've probably are used to hearing the word catch-up used. Traditional way is when an employee contributes more 401k than the limit is, the IRS limit. So for 2025, the limit, and we'll look at this on the next slide, but the limit is 23,500, and for a typical employee, and the catch-up limit is 7,500. So it just allows those employees to make additional contributions. The second way, not as common, but sometimes a plan may impose an overall plan limit on deferrals. It's a document might say, a plan document might dictate that, for example, a participant can only put 10% of their compensation in a plan. So say an employee makes $100,000, they would be limited to a $10,000 401k for that year. But if the plan also allowed catch-ups, that employee could do $10,000, and then if they were over age 50, they could do an additional 7,500. So that's not as common. Third way, as your TPA, when we do testing, ADP testing, if you're not a safe harbor plan, we often use catch-ups as a tool to help when your ADP testing initially fails. And you might be familiar with the term highly compensated employees and ADP testing. So sometimes your ADP test might fail, and we try to do some things to make it so that your highly compensated employees don't have to take refunds, or maybe lower the refunds. So we can sometimes use catch-ups and reclassify some of the refunds as catch-up contributions, and that sometimes will eliminate refunds or reduce the refunds. And that's doing that, we just reclassify some of the money as catch-up in the plan, and it's not even coming back to the employees. So that's some of the behind the scenes things we do with catch-ups in your plan. And on the next slide, we'll look at the catch-up limits. So this year we have catch-ups, and now we have something called super catch-ups, kind of a catchy phrase here. So super catch-ups were first come into play in 2025. So we have, we did a little chart here for you. So 2025, if you're under the age of 50, the regular limit is 23,500. Over 50, 50 and over, you can do the regular 23,500 plus an additional 7,500 for a limit of 31,500. Or I'm sorry, 31,000. And this, we're just talking 401k contributions. This would be your pre-tax and your Roth combined. This doesn't take into account any match or profit sharing or safe harbor that the company makes. This is strictly employee money that is put into the plan. And now we have these special group of employees called super catch-up eligible people. And these are folks that are age 60 to 63, and they can put into the plan 23,500 plus a catch-up amount of 11,250 for a total of 34,750. So these amounts are for 2025. There's a chart here, and we also email you these limits at the end towards usually in October is when the IRS puts out these limits. So hopefully in about a month and a half, we will be sending out the limits for 2026 for you and update those. So on the next slide here, we will go over. So now we get into Secure 2.0, which kind of puts these two things we just talked about together, the Roth and the catch-up. So we kind of went over what both of these are. So there's this Secure 2.0 encompasses a ton of new rules with retirement plans, but the one we're targeting today is called, it's Roth Catch-up for higher earners. Now, you've probably heard of highly compensated employees, but that has to do with ADP testing. That's a different term than higher earners. This is a new term. So effective with plan years beginning January 1st, 2026, so just a few months from now, the IRS says, or the new regulations say that higher earners must make catch-up contributions as Roth. So again, the catch-ups are anything over the regular limit, so over the $23,500 limit. So they don't have a choice. They can't make catch-ups as pre-tax any longer. And again, if your plan, which is not common, imposes a percentage limit, that would be considered a catch-up too. But most plans don't do that, so that's not too common. So anything over the catch-up limit has to be going as Roth. So what is a higher earner? That is defined for us as those employees with FICA wages greater than $145,000 in the prior year. That $145,000 limit is indexed each year, similar to how all the other limits are indexed, like the deferral limit, it's indexed each year, so it'll probably go up a little bit each year. And just a note, FICA wages are also on the W-2 box 3. So that being said, there's some employees that might not be subject to these rules. If you have or are an owner of a company, a sole proprietor that receives a Schedule C income, or a partner of LLC that is Schedule K1 and does not get a W-2, you would not have box 3 W-2 income, and you would not be subject to these rules. So if you're a sole proprietor and your Schedule C income is, $600,000, you're obviously well over the $145,000 limit, but you are not subject to these rules. And that is as of now. If there's ever any further guidance on that, we'll let you know, but that's how the rules read as of now. On to the next slide here. So with these new catch-up Roth rules, or with any rules, there's always going to be some challenges, but NOVA is here to help you, and obviously you have a designated account manager at NOVA, and we're always here to help you, guide you through these rules. So we've sent out some communication already, and we'll send out further communication on this, but always feel free to contact your account manager for guidance. But plans now must either offer a Roth provision, and that's probably why you're on this, we're invited to this webinar. Your plan probably does not have a Roth provision at this time. So your plan will either need to add a Roth provision, or if you do not choose to do that, you will have to remove catch-ups from your plan. So you want to consider all these facts, the advantages, disadvantages of doing that before making that decision. Your plan will need to allow in-plan Roth conversions to deal with corrections, which we talked about in an earlier slide. And this is, again, that's what happens. The corrections will happen when an employee accidentally makes catch-up contributions as pre-tax and they should have been Roth. Well, they will need to be converted. So for example, if an employee makes $25,000 pre-tax and at the end of the year you realize that they went over by $1,500, should have been Roth, the way we'll correct that is converting that pre-tax over to Roth, that additional money that they're over. Another challenge, just payroll companies and software providers will have to be updated to track some of this. On our annual census that we collect, we're going to have to ask just for another piece of data to help you track these higher income earners. So we'll need to get box 3 wages from you. And then just again, providing additional education to you as the plan sponsor and you providing education to your plan participants. And then, so those are some of the challenges, and we just want to go over our timeline of implementing some of this. You've received email communication from us regarding this. So by September 15th, we ask that you notify your NOVA account manager if you do not want to add Roth. Our default is that we will prepare a plan sponsor level amendment to add Roth to your plan. That will be the default, and that's what we advise that most plans do. But if you choose not to do that, if you want to instead remove catch-ups, we just ask that you discuss that with your account manager and make sure that's the best option for your plan. Either way, if you default to add the Roth, we'll do the amendment for you. If you decide to remove catch-ups, an amendment is required as well. In early October, we'll post a new summary plan description, and if your plan's safe harbor or auto enroll, we'll post those notices to our plan sponsor link and send you an email communication to you and let you know to distribute those to your employees during the fourth quarter. In October, we're going to be working behind the scenes to update your plan's record keeper and let them know to add Roth provision to your plan. So then come January 1st, your record keeper will be ready to accept those Roth contributions for your participants. And then in November or even sooner, you're going to want to coordinate with your payroll system or payroll provider to update your deduction codes to add Roth. And every payroll provider is going to be different. Some of them you might update this online. Some of them you might need to submit a form to update for Roth, or some of them you might need to call. So it just depends on your payroll provider. And then on the next timeline, throughout the year, you're going to want to monitor the pre-tax elections for your high earners to make sure no one exceeds the limits. If employees are making catch-up contributions, again, you're going to want to make sure they go into the plan as Roth. And then at each entry date, if you have monthly, quarterly entry dates, you're going to want to monitor the same thing as far as the pre-tax elections and the not exceeding the regular limit. In January, again, on our data collection, we're going to be asking for box 3 of the W-2 so we can help you monitor and keep your plan in compliance for these higher income earners. And then you're going to want to, in 2025, well, I guess it'll be 2026, January, January 2026, you're going to want to review the 2025 W-2s for the FICA wages of your employees to determine who will be the high earners, and let them know that any catch-ups they make will need to go into the plan as Roth. So that is the basic timeline, and we're going to be sending you communications. And so now I'm going to turn it over to Kim so she can go over some best practices on how to help you implement all of this.
Great, thanks, Michelle. So I'll kind of take over from here and want to kind of talk through some best practices. So, we realize that a lot of you guys on the call today are just adding Roth, or maybe deciding whether you want to add it or not. Your plan does not currently offer Roth, so now with these new regulations, you will either need to offer Roth or remove catch-ups. So just want to talk through some best practices as we, go through the fourth quarter and into when this goes into effect in January. Now, you could have added Roth sooner, like you could definitely add Roth now, but it will become a requirement in January of 2026. So again, because Roth is totally new to your plan, there are some best practices that we will help you with, and that some other involved parties will help with too, and play their role. So for all employees, Michelle talked in earlier slides about how record keepers will be updated. Nova will update record keepers for the addition of Roth. The record keepers will then generally be involved in updating enrollment forms, updating election forms. A lot of the record keepers, depending on which one you have, may be online. But either way, going into the fourth quarter, you do need to let all of your eligible employees know that Roth is now available in your plan. So first, letting everyone know that, hey, Roth is new, effective January or sooner if you have it sooner, that Roth is in the plan and employees can take advantage of that option in general. Of course, any internal enrollment materials you have for your company will need to make sure and be updated as well. A lot of the times the record keeper will assist with that, or the record keeper will be the one to have that with you, but you just want, or for you, but you just want to make sure that for any new employees you're offering them and giving them the most current information, the information with mention to Roth. So we'll talk a little bit more about your payroll provider as well. Entering into the end of the year, you'll need to make sure that your payroll provider has added Roth, that Roth is a separate deduction. When Roth first came out, there was concern that, maybe payroll providers couldn't accommodate it. And, there was a little bit of a lag time with adoption. But now here we are almost 20 years later after Roth was first introduced in 401k plans, and pretty much every payroll, or definitely every payroll provider, can accommodate this. This is a very common thing, kind of just a separate deduction in your payroll system. Also in your payroll system, you may need to make sure that super catch-up has been turned on. Again, some payroll providers might do this automatically, but it is a best practice to check with them to make sure that super catch-up option has been turned on. And then just a little check to do with the record keeper to make sure that additional source has been added. And we'll talk a little bit more in detail that in the coming slides. So I'm going to kind of hit on each one of these points. So that's what you want to do, like, to take care of all employees, or all eligible employees. With the introduction of Secure 2.0, of course, they've changed the rules a little bit, and it's double changed for you guys who may not have had Roth at all before. So we have the addition of Roth, but then we also have the addition of this, high earner catch-up limitation, or catch-up must be go in as Roth, as Michelle described in earlier slides. So again, there's several things we need to make sure we're paying attention to as we enter year end for this, Roth catch-up for the high earners. So of course, we'll need to work with the participants so they make elections, so that maybe pre-tax don't exceed the 402G limit, and anything over that goes into Roth. You'll want to review any paperwork that you have on file for those high earners, and make sure that any new forms we may want to get from them has been done by year end. And then we'll want to touch base with payroll provider and record keeper to see what options or what checks they may have in their system to alert you if someone does exceed that 402G limit. Okay, so breaking it down a little bit further by each party, if you will. So again, here on this slide, talking about those affected participants. So the participants who are high earners, who are subject to this, you will need to make sure you have a way to identify those people, in your payroll and in accounting practices. So we want to work with these specific people to make elections so that any pre-tax deferrals they make don't actually exceed the 402G limit. One example of that would be encouraging employees, these affected employees, affected participants, to mark on their election form that they want a certain percentage in pre-tax, or a certain dollar amount, I'm sorry, in pre-tax, and then anything over that would go into Roth. So in our example here for next year, if the 402G limit's 25,000 and the catch-up is 8,000, if your employee wants to make 30,000, we would recommend that on the election form and what you put into your payroll system would be such that the pre-tax elections would, they would just defer the first 25,000 as pre-tax, and then the amount above that go in as Roth. So if you get that affirmative election, it's just a little bit easier. And why is it easier? A couple of things that, Michelle kind of hit on, that in-plan Roth rollover earlier, and then we'll talk about a few in a moment, but if an employee does, for example, do pre-tax for catch-up and they're not supposed to, then it has to be corrected. So we have to go through a correction method. We do have a couple of options, but each option could potentially involve fees to correct. Both will involve additional paperwork. So, if we talk to the employee up front and beforehand, we do find it's just, it's just smoother. They know what's going to happen to their money. They know what to expect. So getting that positive affirmative election really goes a long way. So a couple of additional things you can do as an employer of the 401k plan. Again, really driving this home here, but reviewing, not only reviewing the election forms with the affected participant, but having procedures in place to prevent these. So, one, encouraging employees to fill out election forms that comply, but also having procedures where internally you check this throughout the year. So, maybe it's at the beginning of the year during January, check that to see, did anyone defer Roth catch-up that wasn't supposed to? It's much easier to actually fix it and correct it in January than in February and beyond. So really having sort of internal company procedures to maybe in January check this to make sure no one went over, or I'm sorry, no one, put pre-tax money in ketchup that wasn't supposed to. And then maybe having another check after W-2s are issued as part of your W-2 check process, kind of just checking that for ketchup eligible high earner employees. If you have a lot of employees in this category, I mean, you may want to monitor it on a quarterly basis, just to make sure employees didn't go in, make a different election. If they had elected on a percentage of pay, that could, skew it a bit, and an employee could inadvertently do pre-tax to catch up, unless they were really on top of it. So just a suggestion to do a few little additional internal checks. Continuing on, a couple of other best practices, revolving around the special Roth catch-up for those high earner employees is, really it comes down to communication. You do need to communicate with these specific employees about their elections, about the need to do, up to the limit in pre-tax, and then anything over that under catch-up will be Roth. Correcting these, we did touch on this earlier, but correcting W-2s is not as easy as it sounds. So under the current, way and limitation, we are able to correct a W-2, sort of to update a W-2. Under that type of option, if it came January and you notice that someone did pre-tax that should have been Roth, we could simply transfer the amount that should have been designated Roth from the pre-tax to Roth. But unfortunately, that can really only be used if the W-2 has not been filed for the year. So generally, it's best if that is caught in January. So in January, easy fix. But once those W-2s have been filed, we may not have as easy as a solution. Excuse me. So what is our other solution? Excuse me, I'm just getting over a cold, so now I'm starting to cough again. So I do apologize on that. So another correction, and again, Michelle talked about this earlier. The most common correction will likely be that in-plan Roth rollover. And so that's where a plan simply would transfer the incorrectly allocated deferrals from the pre-tax to the Roth account. So again, that money's already been deposited. The transfer would be something that Nova would likely help you facilitate with your record keeper. In that situation, again, if it happens after January, after the W-2s are filed, then the transferred amount would have to be reported on a 1099-R. That would have to be includable in the employee's income tax for the year. So even with that, we would still have additional paperwork, additional fees, all of that when we do that correction. Again, I really do apologize. I thought I would get away doing this without starting to cough, but here we are. So thanks for bearing with me. Okay, moving on to payroll provider and what their involvement is. So again, we talked about before, you will need to update your payroll provider. Nova generally does not have an established relationship with your payroll provider, and generally your payroll provider will not take direction from Nova. So you do need to make sure that Roth is added at your payroll provider and that Super Ketchup is added at your payroll provider as well. We do expect that once that's added, payroll providers will automatically correct the issue of Roth catch-up, and some may be able to provide warnings. So again, every payroll provider is different. So you'll want to check with your specific payroll provider to see what they are planning on doing. I can't issue a blanket statement of, every payroll provider does X because they are doing something different. But the hope is that either they'll automatically correct them or they'll at least provide a warning to you when processing payroll that you're about to have one of these affected employees go over that limit. Okay, the record keepers. So we talked earlier, Nova is going to update your record keeper for you for the addition of Roth and to comply with the Secure 2.0 regulations. Now again, every record keeper is different. So depending on what record keeper or investment provider you have for your plan, they may be tracking this or they may not. So we do expect a lot of record keepers or some record keepers to automatically correct these and maybe even to provide warnings. The caveat there, however, is they have to have the data to do that. So there will possibly be a mechanism for you to tell them which employees this Roth catch-up applies to. There could potentially be a way for you to import the FICA earnings to them so that they can actually have an indicator to give that information back. There is some question on, if a record keeper does detect this, will they reject the whole payroll submission? Will they just reject that one? Will they send the money back? Some of these questions are still outstanding. Again, just like, Nova and TPAs, have to help, help you guys comply. Record keeper and payroll providers are also updating their systems. So with big record keepers that have thousands and thousands, hundreds of thousands of clients, the volume leading into year end, they are building out, different items and different things to improve their system to be able to help you track things, help you comply. But there are still things that are unknown that will hopefully become more clear as we enter year end. After Roth is added, and I do expect as we approach year end, record keepers will be sending out more information to clients regarding what kind of tracking and support they are providing. Again, every record keeper is different. Generally, record keepers are able to notify you and to have alerts if they have the data. So, if they have the data to be able to indicate who is highly earners, then it is likely they would have some kind of indicator that would at least alert you, if not stop the payroll submission process if you're trying to submit. Okay, thank you for bearing with me and my cough drop here. Okay, so we have a few FAQs. Just kind of talk about a little bit more. I know that this is all new for many of you guys. You probably have heard about Roth before, maybe in the context of a Roth IRA or something like that, but it's not traditionally been in the 401k plan. Again, we really do think that there's not a lot of downside to having Roth in your plan. It does allow your employees to have additional options. It is a separate payroll deduction, but again, payroll companies should be able to handle that. And that is a separate sort of bucket or money source when submitting contributions to your payroll. So today you have probably like a pre-tax bucket, maybe a match bucket. This will be kind of an additional Roth bucket. Matching contributions are applied in the same way to Roth and as they are to pre-tax. So it is an additional little updating payroll. updating record keeper, but at the end of the day, we do really think it's a benefit to your employee. And of course, as we talked about in the beginning, the downside to these new rules is if you don't have Roth in your plan, then you can't have catch up at all. For those high earners, so really do think this provides the best benefit for all your employees, especially those high earners. So again, the plan is that unless you let us know otherwise, we are going to adopt this amendment on your behalf. The amendment will just basically add Roth option to the plan and add that in-plan Roth rollover so that we can have the correction option. And then you'll need to notify your account manager if you don't want to add Roth to the plan. So that's my first point here. If you don't want to add Roth to your plan, you do not have to. This is not, we do still need to amend the plan, so we'll have to make sure the plan is in compliance. But please reach out to your account manager to talk about, if this makes sense for your group or not. It is not mandatory. If you don't wish to add Roth, you'll just need to remove catch-ups. So your account manager will work with you to amend catch-ups out of the plan so your plan can remain in compliance. Of course, again, if removing catch-up just reduces the amounts that employees can put into the plan. So over age 50 employees, it just reduces the amount they can put in. And then also, if you are subject to ADP testing, it could potentially hinder you there as well if you don't have catch-up contributions in the plan. Another good reason to just check in with your account manager on your specific plan. Well, we just talked a little bit about this, but following on removing catch-ups, if you do move forward with removing catch-up contributions, what will happen is we'll send you an amendment via DocuSign, and then once that's signed, we'll give you that new summary plan description and any other notices that you may need, like safe harbor, auto enroll, and then you'll need to distribute those out to your employees by year end. If you remove catch-ups, the record keeper will also need to be updated. Nova would help you with that. You would want to make sure you communicated this change to participants. If you don't have anyone age 50 today at your company, it might not be as big of an issue, but if you are removing catch-ups, you will need to communicate with those employees over age 50 that they will no longer be able to do that. And then your payroll provider will need to be updated. And you will need to take care of that, of updating your payroll provider before 1/1 of 26. So, these rules were something that's originally effective in 2024. But again, this is such a technically, it's such a involved regulation change, meaning that so many different parties are involved in making this happen administratively. So it did get delayed until now, until 2026. Earlier this year, in the summer, there was a lot of industry chatter that the IRS was going to release final regulations and that it would change this. And so many very respectable people in the industry and many stakeholders have requested a further extension of this administrative transition period. But as we get closer to the end of the year, we haven't heard anything from the IRS. So it looks like they've not shown a lot of interest in it. Yes, could there be something else that comes? There could be. But right now, we just think we're getting closer and closer to that January 1st date. So we are recommending and we're putting plans in place now to move forward to help our plans comply with the January 1st date. So with that, I don't really have any more FAQs. If you do have any questions, feel free to type them in. We'll have your account manager reach back out to you, and or we'll send you an email with the answer. Again, our main phone numbers here, like our receptionist can get you to your account manager. We do have additional webinars posted throughout the year. For this, we will be sending additional information, like Michelle mentioned, um, late September, early October, and your account manager will work with you, you know, now to help do whichever way you want to, add Roth, remove catch up, and yeah, expect to see more details from us. And thank you for bearing with me as I coughed and needed to use a cough drop on here. So hope you guys have a great day. Ava, did you have any closing comments?
Yes, just real quick, if you guys do have any questions, just reach out to us at webinars@nova401k.com, and we'll get those questions to the account manager. If you do want to rewatch this webinar, we will have it on our YouTube, which you can find on YouTube at Nova401k. You can also find it on our website, which is Nova401k.com. If you guys do need anything else from us, just email us. And then thank you so much, Kim and Michelle.
Thanks, Ava. Have a great day, everyone.
Thank you.